Hi, good afternoon, everyone. I hope you can hear my voice clearly. Anastasia, can you give me a okay there?
That's great. We can hear you. Thank you so much.
Thank you so much, everyone, for coming to this seminar, workshop, webinar. My name is Faye. I'm an associate professor of accountancy from Geese College of Business, University of Illinois. So I'm very glad and I'm delightful to have this opportunity to share some of my own learning notes when I'm using Wolfram technology as a very powerful tool to help with my creation, to help with my research, as well as my teaching in data analytics. So let's just get started. I'm sure during the webinar, there might be places you will need clarification. There might be places that you want maybe something resonates with your previous experience, or maybe something that does not exactly sound right, that are consistent with your intuitive understanding or your business understanding. Either it's a tech question, it's a coding question, it's a question related to the domain knowledge with regards to accounting and finance. I'm very happy to engage in more conversations with you either during the webinar or after the webinar. So during the webinar, if you want to, I'm sure there is a place that you can type in your questions either with Anastasia or just directly share with everyone in the room so that we can see the question, and I will try my best to kind of go through these questions when I talk. So with that, let's get started. I do want to give credit first to my two very dear friends and collaborators. So Kelvin Mistral is also a Wolfram U instructor. He is an academic enterprise account manager at Wolfram Research. I collaborate closely with Kelvin, and he teaches me a lot about all kinds of Wolfram knowledge and strategies and tricks. Dr. Su is also my collaborator in this webinar talk. So he is a serial entrepreneur. He also has founded successful ventures in pharmaceutical industry as well as tech industry in general. He's also an investor with 20 years of quite successful investment experience, and some of the content here are based on Dr. Su's corporate training materials, but we are adapting this to the Wolfram software environment. So with that, let's get started. So today's talk, my title of the webinar is Equity Trading Signal, which is based on the US banking sector. And here I will introduce how an event-driven trading strategy in the US banking sector and everything, a lot of the workflow could be embedded seamlessly into the Wolfram kind of like environment. So what is the overall picture of this, right? So we all know that the banking industry is the backbone of the capital market, households as well as real business sectors. And our intuitive understanding there is when the Federal Reserve makes some changes to the interest rate. This means a basic parameter on which all these banks operate is changed as an exogenous shock. How to intuitively understand this? Let's think about how banks, especially commercial banks, make money as their basic business model. On one hand, banks take deposit from household. So they need to pay not only the principal as well as the interest for their deposit, which is their business expenses. On the other hand, banks would make money when they are giving loans and mortgages to private sector as well as business sector. So when they are giving the loans, they charge the interest rate, and that is their interest income. And the interest income subtracted by interest expense would give them the net interest income, which is how banks would have their basic profit-making model. So with that being said, right, we have this intuitive understanding that when the Federal Reserve changes interest rate, it might affect how banks are operating, and affect the degree of difficulty of banks' operation, affects their sensitivity on the both asset side as well as the liability side for their yield curve. So how exactly do we dissect this business problem and using data to sort of enlighten us a little bit better with regards of what's really going on behind the curtain and help us using the data to understand how macroeconomic factors can affect the event-driven kind of like banking returns. During the talk, you can see that most of my data analytics here, I don't just present a table or some numbers. I'm a true believer of being a visual thinker. Like I feel like visualization helps with people when they're doing their computational thinking skill. And if we can see something visually, vividly, clearly, it helps us better understand the mechanisms that's behind the curtain. So every time when I'm introducing one additional concept or an additional kind of argument, hypothesis to test, I always present this in a visualization format. Another really important component of this webinar, which I felt it's well received when I teach, and also it's a really important tool for myself during my research, is the API connection. Within the Wolfram technology environment, it really can be seamlessly embedded. So I'm going to talk about this and also give us a sufficient kind of like break time if you want, so that we can all type this in our local device and replicate what you see I present here as a visualization in your local device based on the notebook that's already provided. Okay. So as I was talking with Anastasia earlier, I don't really know everyone's background here. I'm sure there are a lot of very advanced mathematical users that are super tech advanced, but I don't know your background with regards to the Wolfram mathematical language. And my habit and my personal belief is that I just don't want to make any assumptions. So if you're one of those very technically advanced user, please bear with my slow pace because I'm going to walk through everything that I'm going to talk about step by step in a very slow pace that I don't assume anyone to have previous background with the usage of the Wolfram language here. I also want to say that my webinar is more going to focus on the visualization, data storytelling side, how we can use the workflow to generate some visualization to help us with the understanding of the business underlying principle rather than the coding details. I'm sure these days, a lot of times we can rely on our good AI friends to give us more help when it comes to the coding details. So just a quick summary here, right? Our objectives for today's webinar. First part is going to be how we can directly link to the Federal Reserve macro data in generating a visualization or exploratory data analysis directly based on the macro data series provided by the Federal Reserve. With that, we're also going to move to using the Federal Reserve interest rate decision as an exogenous shock, as an event, to take a look and see how Wolfram technology enables their curated financial data set so we can visualize the long-term equity performance as well as short pre and post event returns, and how this helps us better understand the event-driven trading strategy when we can directly link the dates to the Federal Reserve's interest rate decision. And the very last part, the third part, is that I'm going to say, if we do see interest rate is an important decision, and then we will be able to see clearly how we can visualize the pre and post event returns and maybe generate some trading signal there. Before that even happens, I think a very important part is to understand why that is happening. And if we can rely on corporate insiders, those are the executives, the leaders of the commercial banks, can we really better understand the impact of exogenous shocks on the individual stocks when these company CEOs are getting on the conference calls to answer questions from analysts? And the specific example we're going to use is one of the most recent quarters from JP Morgan Chase, and the presentation and the question and answer based on their CEO, Jamie Dimon. And we're going to take a look and see how we can use the embedded AI function that are embedded into Wolfram technology to provide a intuitive and also visually powerful narrative to conduct some textual analysis. So that's going to be today's learning agenda. So far, so good. If there is any question, please do feel free to let me know. I look forward to our webinar here together. Okay. First things first. So let's start by taking a look at if you think about what I'm going to talk about as a canvas or as a plain notebook, right? So anytime when we're starting to think about the data analytics, it's always about what is the entity that you focus on. So in today's seminar, because we want to focus on the U.S. banking industry, which means that we want to select some stocks that we're interested in as a starting point. And in this webinar, the four ticker symbols that I select are four of the major players with the commercial banking industry in the United States. All four of them are banks that are listed in the New York Stock Exchange. So more specifically, we have Bank of America, Citigroup, JP Morgan Chase, as well as Wells Fargo Bank. Okay, so if we, you already have this notebook with you, right? So the correct way of execute the block of code would be you either click on the outside wrapper using your left click with your mouse, and then you right click your mouse and then say evaluate this cell. You're going to see this dialog box. It says, do you want to automatically evaluate all the initialization cells in the notebook? Just click yes. Okay. And right there, you don't see any output. This is for the reason that I've put a semicolon at the end of each of these sentences. So all of these outputs are going to be suppressed. But I do want to pause here a little bit to open a new canvas so that you can see what exactly was I doing here when I say here is a ticker, here is a stock, here is the company, and here is the logo. So this is the starting point and the preparation of what kind of data and what kind of companies we are going to look at right here. Okay. So what I'm doing just now is I'm moving away from my main presentation notebook, the notebook you have already got before the presentation started, and I'm moving to a new canvas. If you want to type together with me, you can also click File, New, and then Notebook. Then you will get to a completely fresh and clean canvas to start with. What you're going to see is going to be a gray line, and you're going to see a little plus sign, and you're going to see that this is the mouse hovering here. So if you just start typing, then it's going to be by default taken as an input, right? So what I did here is that let's use one as an example. So so you can see that to start with, I say that the ticker I'm going to focus on is going to be Citigroup, right? And a lot of you probably already know this. We can also, within Wolfram Language, to try to interpret this ticker that we are seeing right here as Citigroup, right? What's very nice about this changing from a plain language input into a data entity, this orange data box, is that now you can activate the curated data set features within Wolfram so that you can see that this Citigroup now is a financial entity, and that means all the stocks, price information, volatility information, risk information, trading volume information, as well as a lot of the visualization could directly be activated there. Okay, and with that, I'm going to look at company, and this stock, let's just say this, Citigroup, and then the company. Seemingly exactly the same output, but they mean different things. Here, Citigroup is interpreted as a company, and once you have this activated, you'll be able to access their accounting items, their accounting statement items, and their business items. Okay, so, and if you do logo, you can also get, there is a great range of features that you can start to start working from there. Okay, so this is the 4 stocks we're going to be looking at for today. Okay, with that, let's move to the next part of the webinar, which is going to be how do we visualize the important players within the banking industry, right? You probably already know that the banking industry is heavily regulated in the United States. So for the US banking sector, when we are thinking about the important players, probably what we are thinking about are the chair of the Federal Reserve, as well as the secretary of the Treasury. So here, based on the notebook you already obtained, if you directly execute this part of code, so you right-click, then you evaluate a cell, or you can just do the Shift and Enter version, you could get this visualization output. So the first output here shows the date appointed and the date left office of the previous and the current chair of Federal Reserve, as well as the secretary of the Treasury. I would say that the chair of the Federal Reserve and secretary of the Treasury, they talk frequently, they probably meet every week, every month, and the interest decision is kind of like heavily involved of the committee meetings of these important players, but then the ultimate speaker for this is going to be the chair of the Federal Reserve, which is Jerome Powell. Okay, so with that, let's also take a quick look at all these companies that we're looking at in today's webinar. We're going to take a look and see how we can make sense of Federal Reserve's interest rate decision making. We also are going to take a look at how Federal Reserve's interest rate decision are going to affect the company, especially these big 4 banks, event-driven kind of returns, pre and after Federal Reserve's interest rate decision. So let's get started there. Okay. So in the next section, what I'm going to do is we are going to try to visualize the important macro indicators with the center focus being the interest rate. So in this section, we are going to provide a visualization of the key economic indicators, unemployment rate, inflation rate, as well as interest rate. So what's our intuitive understanding of these 3 numbers? Probably hear that from the business news, when unemployment rate is high, then Federal Reserve faces the pressure of dropping the interest rate for the reason that they want to add some fuel, add some energizer to the economy so that they would encourage firms to borrow and to invest and employ. So these 2 numbers probably shows a negative correlation. On the other hand, when inflation rate gets high, that means the purchase power of the US dollar gets weaker. That also means that you will need to spend more in purchasing the same commodity and the same service that are essential to the household. So when inflation rate gets high, Federal Reserve a lot of times face the pressure that they will need to increase the interest rate to tame the inflation rate. So in that sense, a lot of times Federal Reserve is facing this dilemma that how to prioritize the current task. Should they focus more on kind of like curing of the unemployment rate in the society, or should they focus more on taming the inflation rate for the US household? We're going to see how we can use the Federal Reserve macro data series to generate a nice visualization there. Okay, So let's go ahead and get started. So what is this FRED macro data series? Okay, so if you go to FRED, stlouisfed.org, or basically just Google Federal Reserve data, then you will be linked to this website. As you can see here, this is partly based on the Open Government project, where a lot of the macroeconomic series, for example, I'm going to use this one, unemployment rate, as an example. Okay, so this is a nice data interface. So what we have here is the Federal Reserve's unemployment rate. Depending on the filter you want to apply and depending on the specific frequency that you're going to choose, you can edit the graph right there. You can also download the raw data, right? So when we think about how to visualize several economic series, we want to provide in this two-way coordinate system, as the time moves by, probably not only just unemployment rate, but a few other indicators, right? Some people might be curious to see how does unemployment rate is related to inflation and interest rate. Some other people might be wanting to see how do we see whether unemployment has any implications for the trading of the crypto or the commodity prices. So the only constraint there would be the imagination. So there is a lot of macroeconomic data series that are available with Federal Reserve that should be useful, and it could be easily integrated into the Wolfram environment. So let's take a look and see how we get that started there, right? So this part is already done. So let's move to the next part. What I'm doing is I'm moving to a new line of the code, and I'm trying to start a new service connection. Did I type something? Service, no, service connect. So service connect. Federal Reserve economic data, let's say new, because I want you to see exactly the same thing as what I'm seeing here. So once you do service connect, Federal Reserve economic data new, and if you shift enter or you just evaluate this block of code, it gives you an opportunity to get your API key. I'm just inputting mine, but if you don't have one, okay, if you don't have one and you do want to try this by yourself, if you Google how to get Federal Reserve data API keys, that really just takes one step, and it's going to be a free one. It's not going to be take any subscription fee or anything like that. It's a free access to use API key. So if you give your email and registration there, you can quickly input that as what we do here. Remember to click save this connection, and then you can do agree and continue. So interesting. So for now, let's give it a quick test to see whether my connection is already established, right? So let's say that I want to start by looking at the interest rate, and here I'm just calling this service connection, and then I think I'm going to get the series data, and the ID here is going to be the 6 months Treasury bill rate, right? So this is what you have in the notebook, and this is what I'm going to use right here. So let's take a quick look to see what will happen if I try to, okay, let me try another thing. Sometimes they happen, but I'm very sure this is not something that we cannot fix. So let's go ahead and try to reestablish this service connection here. There, this time it worked. So we got the service object connected, and what we're going to do is we're going to extract the Federal Reserve economic data, which is the 6 months borrowing rate. So this feature may not exactly look quite familiar for us regular kind of like data scientists, but if you kind of like normalize the presentation of the rate interest, then you're going to see something that's much more familiar. So basically, this is monthly data, and what we have here is starting from the year 1958 up until this month. So for each month, Federal Reserve is, through the API, is directly giving us this 6 months borrowing rate, right? So this is how we can get the rate of the interest, and not surprisingly, if we get the rate of the unemployment rate is going to be, so you can see that for the unemployment rate, then we can also extract a time series from 1948 to most recent kind of like quarter, and then we have the 2 time series right there, right? So how does this enable us to quickly do a visualization so that we can see what's going on for the relationship with interest rate as well as the unemployment rate? So here, if we do a date list plot for 2 of the data series that we just called, okay? Let's see what happens here. Okay, so now you can see very nicely we have a 2 curves that are presented there for us, right? So it's hard to make a guess what is the positive or negative correlation there, and also we don't rely on guessing. We rely on more kind of like solid statistics to make our assessment there. But for now, let's say this is a bit hard to see. If I do want to look at the intertime kind of like change. So if I move this to the a wider version, it allows me to see, especially for the recent years, right? Many times you see that when the unemployment rate goes higher, the interest rate kind of goes lower. And you can always see this kind of like increase with the dipping, and then so this is still not clear for the reason that it's just not specifically to the range that we want to look at, right? So for example, if I want to say date object, I want to interpret this as a year, and then let's say I want to just looking at what happens after the internet bubble crash. And I'm going to look at from the date object 1999 up to today, right? So what is this range that we're looking at? We're looking at from year 1999 exactly to today's date. So let's see whether we can get a better graph there. So with that, I probably also need to add the plot the range here as well. So not only the date object, but also the Y range. Okay, so what are we seeing here? Is the orange line is gonna be the unemployment rate, and the blue line is the rate of the interest. Can we try to make sense of this, right? So we can see that in the year 2008, which is the past financial crisis, here the rate of the unemployment increases because it's a crisis period. It jumps from a bit under 5% to a bit over 10%. And a natural move for the Federal Reserve during that period is naturally to drop the interest rate. And you can see that that really opens a really long period, which is over 8 years of super quantitative easing, and the interest rate was always to the floor, like almost zero interest rate for a long time. During this period, it is really kind of like positive news and tailwind for the overall stock return performance as well. Now, if we move a bit to closer to the year 2020, we know that in just the past COVID pandemic, because of the social distance or because of the quarantine during that specific period, from February, which is unemployment rate is 3.6%, it directly jumps to as high as 15% during that month. So not surprisingly, a proper move for the Federal Reserve is that they, again, very quickly drop the interest rate, right? So this then moves to the most recent period where we begin to see during the year 2022 to 2024, Federal Reserve has a very intensive period of increasing of the interest rate. And what exactly happened there is not about the unemployment rate anymore. So there, if we would involve the inflation data, we would see them more clearly. Okay, let's go ahead and take a look. So in this situation, if we have, I'm just typing this from my previous notes. It's not that anyone can remember these. So this is one of the metrics that used a lot by practitioners when we are measuring the rate of inflation data, right? And from there, we can see if we want to include rate of inflation as well, things would not be super challenging. We can just simply add this additional economic data series, and then we will be seeing this plot that reflect all three of these plot legends. I haven't yet added plot legends. So you can see that here, why is Federal Reserve increase the interest rate? That's basically a response to this very quick climbing up and skyrocketing level of the inflation, right? So inflation changes from 2%, which is a comfortable level that household and society could accept, to a bit around 7% during the year 2022 to 2023, and that's the period when Federal Reserve begin to increase their interest as well. Right. So what are we seeing here in this plot? Now we have kind of like a basic bare bone understanding of what's going on with the Federal Reserve's interest rate decision. They are really trying to decide to prioritize two tasks in the economy. Either is trying to address the unemployment rate, either is trying to tame the inflation rate to the acceptable level. And in the US, that kind of a golden number is like 2% or 2.8%. Okay, so with that, let's move back to our main notebook, where the visualization there is a bit more clear with regards to both the understanding as well as the labeling there. I'm not seeing any questions, which I assume is good news. So let's go back to what we have earlier on. We say that one of our target in this specific module is going to be try to visualize the macro indicators, specifically with the focus of unemployment rate, inflation rate, and interest rate, right? So what you have here is, as long as you get this free API key from the Federal Reserve, you will be able to generate exactly the same content as what you are seeing here. A lot of people may then say, but I'm also very interested to know what are happening with regards to the stock returns, right? So what are happening during the low interest rate time period? Is that good news for stock returns? What is happening when the Federal Reserve is increasing their interest rate? Does that have implications for stock returns or equity trading in general? Which is a very, very valid question. However, in the Federal Reserve data set, because they only focus on providing macroeconomic data, so not surprisingly, it's hard to include a SP 500 returns in this visualization. Now, nicely, Wolfram provide a great environment where you can directly query the specific index as well as the stock. And this not only just covers the United States, it covers 10 of the major world stock indices and their major stocks as well. Including Europe, including Asian area, including Taiwan, Japan, and China mainland. So in this specific example, what we are seeing here is we are addressing the question of whether SP 500 returns would show some strong correlation with the interest rate, inflation rate, as well as unemployment rate. So what's our guess? Do we think SP 500 stock returns would have strong correlation with these, right? So some people, business media probably tells you, oh, when Federal Reserve is having very low interest rate, it seems that SP 500 is doing great. But is that supported by the data, right? So again, I don't want to assume that we have everyone here is already technically advanced in terms of Wolfram so that when you see this, it becomes readable and you know what's going on. I want to go back to my separate notebook for you to see what exactly am I trying to call. What is the function that I'm using to make this part of visualization possible, okay? So let's move temporarily to my practice of calling SP 500 returns and calling stock returns, as well as visualize them in graph. So what is the way that we are going to try to plot the financial data, right? So the basic kind of function that you call is a function which is called financial data. From there, let's say that I want to get Bank of America. And then I want to get the feature which is cumulative return, okay? By the way, there's cumulative return, there's cumulative fractional change. These two are very different. When it's cumulative fractional change, it's only the price difference of the stock. Doesn't really take into consideration of the dividend. When it comes to cumulative return, it takes into consideration both the stock price appreciation as well as the dividend distribution. Okay, so when you're trying to look at the total return of a specific stock, cumulative return would be a much better index. And especially for those high dividend paying stocks, you're going to see a great difference between the fractional change and cumulative return. Okay, what is the next? When we're talking about we want to do a stock return analysis, timing become something of essence here. So let's see. So what I'm doing here is I'm calling the data for Bank of America, and I'm calling their cumulative return. I give a specific starting point. I give a specific ending point. So let's say here is the data. And now it's making the inquiry with the financial data indices. So we will be able to see that during these, how many years? 15 years of data, which is not this multiplied by 365 for there are only 200 something trading days during a specific year, right? So this is the time point when we have the daily returns. How do we visualize this? Now, again, Wolfram has a very nice way of directly plotting the data here. So again, we're just showing a very simple bare bone structure of how you can quickly call the call the stock return data and then generate the visualization right in there. And what is this graph doing? This graph is taking a buy and hold strategy. So it's assuming that in the first trading day in the year 2020, you buy in with $100. Okay. And then over time, what is the cumulative return that becomes, right? So it means that if you go in and buy $100 worth of Bank of America in the beginning of 2020, then up until today, not up until today, it's August 1st, you're going to have a return which is $148. So your $100 is going to turn into $146. Not a really impressive number, but no judgment there at all. So with that, let's see. If I don't just want to get one number for one stock, but I do want to get a SP 500 returns, what is the data that I'm going to call in there? For that, I'm going to call the data which is SP 500. To save us some kind of like some time here, what I'm going to do is I'm going directly to use the table version of this, okay? So let's see. So what I'm doing is that let's say that I don't want to apply this function and I want this calculation of generating the cumulative return for equity from a starting point to an ending point, and I want this to apply to two stocks, one stock and one index. Okay, and by the way, if you put this little raised to the power symbol in front, you are going to get a lot of the stock indices that are available. I'm just going to use the SP 500. Let's see what will happen here. So data 2, you can see that now you're getting not only the Bank of America, but you're also getting the SP 500. How does that help us, right? So it helps us in the sense that now we can quickly change this visualization where we are going to have the date list plot of the cumulative return for both SP 500 as well as Bank of America. So this is not a good habit. So for sure, we want to add some plot legends. It's going to be exactly the same order as what we had here because that's the data's order. Okay, so you can see that Bank of America during this period, it underperformed compared with the SP 500 kind of index, right? So what does it mean? Again, it takes a buy and hold strategy that starts with 100 US dollar. So if you start from here, 100, and then you hold it until August 1st, 2025, if you have chosen to invest in SP 500, at the end of the day, your $100 is going to turn into $191.50. And your $100 within Bank of America is going to turn into $146. So this is all US currency. And not surprisingly, if we are looking at European stocks or we're looking at European investors invest in the US exchange, then one additional step within the Wolfram technology, which is foreign exchange option, would also come in very handy to restore the return of your buy and hold to whatever currency that you are most comfortable with and your fund is using as the evaluation and return calculation. So, okay, we have this right there. This means that we can quickly visualize the SP 500 as well as any of the stock that you call. So with this kind of working understanding, let's now again move back to our main presentation notebook, where we can see a bit better of what we were doing in terms of the SP 500 returns and the consideration of macro indicators. So let's go ahead and take a look, right? Now, some people, right? Some people who like to rely on their bare eyes, it's possible that you can just compare this chart as well as this chart and then try to figure out what is the relationship and positive and negative relationship. I got to acknowledge I'm not that kind of person. For me, I think visualization is one thing, but also at the end of the day, it would be nice to have some sort of the correlation matrix that really shows you what exactly goes on there. So let's take a look. Requires a little bit of the matching. Okay, I'm going to save us from talking about all this long part. You already got the code. What it basically means is that the starting point, the ending point, and then the data frequency is not exactly the same and not aligned across data series. So what we're just doing here for the for the program to give us a clean slate for the correlation matrix, we need to make sure all of the economic data series are truncated so that they're matched, they're aligned to each of the calendar months. So this is exactly what we did in all of these selection tasks. But that's not the important part. The important part is then going to be the final output. What we are seeing here is we define the members, we define the cross correlation matrix, and then we present a nice correlation matrix that shows what are the relationship between these economic data series, right? So our intuition is supported. Federal Reserve, when they are making their interest rate decision, it has a very high and significant negative correlation. It means that when unemployment rate gets high, interest rate would follow, and then interest rate should be dropped. That's usually the proper move of the Federal Reserve. On the other hand, when inflation rate is high, when inflation rate deviates from the acceptable level of 2%, 2.8%, Federal Reserve's proper move is going to be increase the interest rate to try to tame the inflation rate back to the proper level. So this small area shows us the correlation between these three major macroeconomic data series in the society. Now, we can also try to take a look at the SP 500 monthly return, as well as something that we include, which is the U.S. real GDP growth per capita GDP growth rate in the last 25 years. And as you can see here, Federal Reserve's interest rate has a very low correlation with the GDP growth rate as well as the SP 500 monthly return. What does it mean? What's the implication here is, well, usually it's not the case that the Federal Reserve would respond to the stock market. So if someone says stock market is doing so poorly, central bank should do something, that's not really what economics people think. They would think that rationally interest rate responds to inflation rate and unemployment rate. Again, what happens in reality, we don't comment, we don't make any judgment there, but this is what data says about the major correlation for these macroeconomic data series. I hope that with seeing this, it also helps us understand that once we establish this nice talking with the Federal Reserve data set, and once we enable the nice functions that Wolfram has in calling all the stock data, all the index data, it will be very, very powerful and handy when we are trying to throw in a quick visualization or throw in a quick correlation analysis. Then your more advanced backtesting, your more advanced portfolio selection strategy could then also use some of the reference of these macroeconomic data series, right? So we can quickly maybe change this to include one additional column, say the price of the gold, or the price of the petroleum, or the price of the crypto, just so that we can see what is the basic correlation that we see here. Not necessarily correlation says anything about what happens in the future, but still it constitutes a strong prior understanding of what happens in history. Okay, with that, let's now move to the next part of the webinar. So what we finished are the previous three parts, and now we're going to move to the part where we say, well, if Federal Reserve make their interest rate decisions based on whether they want to tame the inflation rate or they want to address the unemployment rate. We all know that in the most recent cycle, Federal Reserve has taken several moves that drops the interest kind of like from 6% range to now kind of like 4% range, right? So Federal Reserve has already go through, here are 3 of them, and the most recent one also already happened. So now the interest rate is more kind of like 4.0 range, okay? So given that Federal Reserve is making these changes, and how do we better understand what are the rationale that the Federal Reserve, are they making a proper move? So recently, some of the very interesting economic phenomenon that's happening here are making this Federal Reserve move super interesting, okay? So let's take a look and see what are we talking about here. Now, again, where the data comes from, it still comes from our previous established link with the Federal Reserve Data API. Now we are not just taking interest rate as one given number, right? So previously when we were doing the visualization, we just look at interest rate for 6 months. For now, we're going to take a little bit look at this yield curve and try to make a comparison of what is the interest rate comparison of the short-term interest rate, 2 years, and the long-term interest rate for 10 years, right? So again, this is probably something that you see in CNBC all the time, that they want to show the comparison of the T to Y rate as well as the T for 10 years rate. What exactly are we expecting, and why is it a kind of like an interesting economic phenomenon? Now, let's check our own intuition. Now, if you think about T2 year as a short-term interest rate, and then the T10 year as a long-term interest rate, right? So what is the question here is, should long-term interest rate be higher or lower than the short-term interest rate, right? So in this case, this is T for 2 year, and this case is T for 10 year. Which one should be higher? Now, based on our own experience in making either investment in the insurance product or kind of like the CD, the deposit, we know that long-term interest rate should be higher than the short-term interest rate. What is the economic rationale there? Because you are, as the provider of the capital or as the provider of the deposit, you are sacrificing your liquidity for a longer time. So in theory, you should get compensated, right? So in theory, it makes sense that long-term interest rate should be higher than the short-term interest rate for T2 year, right? If we take this as given. And if we look at this graph here, let's start with the right-hand side. The 10-year interest rate is a blue line. The 2-year interest rate is the orange line. And the 10-year is higher. The blue line is higher than the red line. This perfectly makes sense. Now, if we move our focus a bit to the left-hand side of this coordinate system, then we are seeing something that's super interesting, which is the short-term interest rate in the first half of 2024 is actually higher than the long-term interest rate. How do we even explain that, right? So economics people would say that this is because a short-term drying of liquidity and long-term lack of confidence. Lack of the confidence for the long-term prospect, right? So the short-term drawing of liquidity and then the long-term lack of confidence can lead to that we are seeing this cross phenomenon where the 2-year interest rate is higher than the 10-year interest rate. And we can see that through these cuts that Federal Reserve did in September 18th, November 7th, December 18th, then the crossing of the short-term and the long-term is now restored, kind of like more to a normal level based on the second half of the 2024, as well as the whole year of 2025. Right? So in that sense, we can see that Federal Reserve is making kind of a rational move. And also, this is not a crisis period. There is not a recession period in the sense that we can then try to make ourselves whether the Federal Reserve's interest cut should be good news or bad news for the bank in general. That would be a super complicated question because it's really not a one-size-fits-all story. Depending on whether the banks are asset sensitive or liability sensitive, and how they are sensitive, the profitability sensitive to their net interest income would be sensitive to the deepening of the yield curve, the specific shock of Federal Reserve to each time, and each bank's balance sheet and financial condition might be different, right? So again, we are kind of dropping those kind of economic analysis on one aside, but just really focus on the visualization of how the event is driven the return using some of the pre and post returns that we could see. Okay, so this is going to be the next step. So before we move to the how-to part, which is how do we really generate these short-term event trading visualization. Let's start by looking at the final output that we are trying to present here. So you got the notebook. If you follow through, then you will see that the seventh visualization within this webinar is a presentation of what happens to the big banks. For Bank of America, Citigroup, JP Morgan Chase, as well as Wells Fargo, for both before the September 18th interest rate cut and after the September 18th Federal Reserve interest rate cut. And then what we are doing here in the whole event is that we try to present the information not only for pre, not only for after, but both for pre and after of the event, what happening for these four major banks in the United States, right? So overall, not looking so bad. If you're thinking that this is just the returns for a bit over 2 weeks, and if you analyze that return to this most recent happened Federal Reserve cut, it seems that it's pretty good news for these banking industry, right? So we're seeing in general kind of like overall tilting up by the end of the event today. Again, what is this visualization that we are looking at here? How is this different from the earlier visualization that we just showed, which has the long-term equity performance? Let's try to zoom in to one specific example and try to dissect and make a comparison, compare and contrast with what we did earlier. So if I move back to my side notebook, okay? The purpose here is to make a compare and contrast of the long-term equity performance and short-term event-driven performance. So intuitively, when we are doing the long-term equity performance, we just rely on the previous graph that we are showing here, which we take a buy and hold approach. We start with $100. We see at the end of the day, how much does $100 turn into for Bank of America as well as the SP 500. Now, this kind of graph, is this sufficient to show how specific event, for example, let me go ahead. Yeah, this date, you can see there is a Federal Reserve cut. But if I just use this kind of visualization, it's apparently not sufficient to show to your audience, to show to your client what exactly is the event's influence of this Federal Reserve interest rate cut to the Bank of America as well as the SP 500. So what would be a better way that we present the short-term event-driven performance? It would be the interactive trading chart. Let's take a look again to see how we can quickly draw that using the Wolfram technology. When it comes to the interactive trading chart, as we mentioned, it's a short-term event-driven performance. So it's super important to specify the starting point as well as the ending point. So I'm just making an assumption here, right? Not really assumption because this is really the date when Federal Reserve cut interest on that specific day, right? So let's say that I have the date, right? I use the date object function, and then I have the date right there. I'm going to quickly do a helper function for myself where I say, it's not really necessary, but yeah. So I define a helper function with yesterday, and now what I can do is I can nest this helper yesterday function with the day and 7, a date 7 to the date that I specified. right? So date refers to September 19th, 2024. Now, in this case, I can see that I'm getting the helper for yesterday. I nested for 7 days, and then I'm getting a nice kind of like time period. How does this helping me? So now if I go ahead and do the interactive trading chart, I'll just copy this right from right here. So now what we're seeing is an interactive trading chart that we have for each of the day. Not only do we have the specific return for that day, we're also going to see the day open, day close. Okay, let me zoom this in so we can see this in the webinar screen. Yeah, I think this should be a good size, okay? So if I move my mouse to any of this date here, you can see that here, this green bar shows several data points. The bottom, the green bar shows the open price. The high part of the green bar shows the close price, okay? And if you look at this green line, then the low point of this green line is the low price, which is $40.01. And then the high part is gonna be the high price for a specific day, 41.04 cents, right? So there, it helps us better understand what is exactly happening for one of these specific days. Sort of an important, but I'm sure a lot of you, probably most of you already know this trivia knowledge is, let's try to ask ourselves a really kind of like intuition check question here. Okay, so let's say that I want to calculate the daily return for BAC. Should I use high minus low, or should I use close minus open? Or none of these are correct, right? So if we use high minus low, or if we use close minus open, none of these are correct. The correct way to do the daily return for a specific stock is today's close minus yesterday's close. And this is so why is this important? Why is this different here important? Is because a lot of times yesterday's close price is not the same as today's open price. Today's open price is not yesterday's close price, right? So only with this kind of interactive trading chart can we see more clearly what is the opening, what is the close, what is the low, what is the high for a specific day, and thus give us a better understanding for what exactly happens for this specific event trading day. And also very nicely, this interactive trading chart would also give you the trading volume on the bottom, and you can also freely choose this based on the specific parameters that you want to have, right? So this is the event trading. The event trading analysis for these 4 banks right after one of the Federal Reserve's interest rate cut. And why is this good news for the bank in general? Well, on one hand, banks are paying their household deposit provider lower interest rate. On the other hand, they probably are also giving the business loans lower interest rate as well, right? So the interest rate cut would affect both your asset side and your liability side. So it's really a closer look of whether these banks are asset sensitive or liability sensitive, and how they can have the pricing flexibility in very quickly incorporate Federal Reserve's price cutting decision. So in that sense, it's not really a clear-cut decision when the Federal Reserve is making an interest rate cut or interest rate increase. Does that really affect, and is it always good news or always bad news for the banking sector before we do this kind of analysis? So even if we just argue these intuitively, it's kind of a generic argument. It does not really zoom into specific banks in understanding what's going on for this bank are their financial statement, are they merely giving short-term loans and they are having long-term deposit, or they are taking mainly short-term deposit and making long-term loans? These two situations are very, very different. In addition, some banks have better national branches, they have better customer quality, they have better customer service experience. So maybe when Federal Reserve is dropping their interest rate, it probably benefits those banks who have more pricing flexibility, who are more asset sensitive, as well as who are good and excel in providing customer satisfaction. So more business would run to them, more household would run to them as well. So it's really not a clear-cut decision. So what could give us a little bit better understanding if you do want to implement event trading strategy for the banks based on these macroeconomic parameters would be the next session of the webinar. So let's go ahead and take a look. So what we did, we sort of finished talking about how Federal Reserves make these interest rate decisions. We take a look at one of the most recent Federal Reserve interest cut and how that affected the banking sector's profitability and this event returns. Let's go to the next part. The next part is exactly trying to answer the unresolved puzzles from the second part. That is, even though I see all of these banks are showing some good news and showing some headwinds or tailwinds based on specific Federal Reserve interest cut, can we really understand what's going on behind, right? Can we really what's going on behind? So how do you understand the banking's specific operations? And what are the executives discussing with regards to the most recent quarter's operations, the most recent quarter's regulatory landscape, and how they foresee what's going to happen next quarter? The best way to look at those for any listed company would be go to their earnings conference calls, right? So not surprisingly, for all of these big banks, they provide nicely PDF version of their earnings call transcript. For example, here, it would be JP Morgan's CFO starting the presentation. And the operator might ask these executives to answer the questions from the analyst. And you can see that here, Jamie Dimon sometimes chip in as well when he's seeing the questions from the analyst. So in addition to the CFO, CEO a lot of times come to these conference calls and answer the questions, right? So it seems to be a daunting task. Why? Most of the time, we are seeing a lot of the terms that are just specific to the banking industry. And we're seeing a lot of the terms that are specific to that operation period or to that bank's financial statement. What would be a good way of quickly understand what's going on with their financial statement and earnings call transcript? That's when our AI friend can come into with handy help. So in this specific section, I'm providing some code using the embedded LLM function provided by Wolfram, and we can see how we can quickly find the keywords that are related to the operations of banking industry and just pick those keywords and see what are the surrounding context when Jamie Dimon and Jeremy Barham are talking about their financial results. So let's quickly take a look. So what I'm doing here, I'm still going to run this, although it takes a bit of time. Anastasia kindly provide the free version of the Wolfram LLM assistant, so you guys should be able to get that key. That should be able to follow through with this LLM approach. Here, what I'm calling is the text summarize function. Text summarize function would just take a very long, very technical intensive, very dense document, right? So it takes a while to see this full document. But what I did here is I just take what you saw previously for this overall Q3 24 financial results and the earnings conference call transcript from the website of the JP Morgan Chase. Then I move this into my text as a text box. What I then do is I say, how about you give me a quick summary of this text? And then I say, how about you give me the keywords that you see within this text, right? So not surprisingly, in the year 2023, if you do this analysis, many of the times keywords are going to be about AI and ChatGPT. If you do this in the year 2024, not surprisingly, a lot of times people are talking about keywords such as data center and security. And for this year, a lot of people are talking about robotics, and different sectors would have different keywords that they have there. So here you can see one of the really important keyword, right? So all of these looks like generic and intuitive, but if let's say that you are a very experienced investor, but you're not that experienced with the banking industry, then maybe yield curve sounds like a technical term that you don't exactly know what's going on there. Okay, so again, some sort of very quickly select, join, and textual analysis provided by Wolfram technology could come as a very handy tool. What we can do here is that knowing the keywords that are discussed. For example, I'm interested to know growth strategy, then I can define my keywords at growth strategy. I'm interested to understand the net income, I can use that as my keyword. For now, let's say I'm very interested to understand how is Fed and yield curve affecting JP Morgan Chase most recent quarter, not most recent, the current quarter during which this earnings conference call transcript is issued. And I want to understand how the CEO, the CFO, as well the analyst who are participating in the earnings conference call is talking about Federal Reserve and is talking about the yield curve. Now it comes pretty handy again, because traditionally the text analysis only gives you these sentences. Now with a bit of more help from, you probably see this right there, the Notebook Assistant and LLM Kit, you can also see a quick summary, and your AI friend is going to break this down for you using the plain languages that everyone can understand. So instead of the tech terms that we are seeing here, once we get the textual analysis to get us some of the keywords, from there, we can drill in to see what exactly is Jamie Dimon talk about. How does Federal Reserve is affecting the JP Morgan Chase profitability, right? And from there, you can see that Federal Reserve and yield curve, it occurs all the time together. For today is not a banking seminar. We're going to ignore all of these specific content. But again, the dilemma there is how exactly are they asset sensitive? Are they debt sensitive? How fast and flexible can they adjust their pricing power and the client base based on the Federal Reserve interest rate, right? So if you're interested, go ahead and read these content. But for now, again, let's say that if I'm interested to see what are the keywords that I talk about when Jamie Dimon is talking about Federal Reserve and yield curve, then this is the word cloud that can be quickly visualized, as well as a nice kind of like picture where all the keywords of the Federal Reserve and the yield curve is talking, right? So with that, the last part, let's say that not only we want to use this as a nice learning journey for ourselves, but we also want to sort of save this as future visualizations so that in a team meeting or in a group meeting, you want to present this to your client when you're talking about their wealth management, their financial planning, their tax planning projects. You can also just very quickly kind of save all of your previously generated visualizations. And with that, right, let's say that if we have the so at the end of the day, right, it will be good if we save a nice visualization image treasure box for us to better understand what's going on. And in this case, in this webinar, just in summary, we learned the technical skills as well as a bit of the business intuitive understanding of how you visualize important players, how you can visualize macro factors, specifically relationship between interest rate, inflation rate, and unemployment rate. We also then take a look at see one of the most recent Federal Reserve interest rate cut. How does that restore the yield curve to the normal stage? And how does this affect the 4 big commercial banks within the United States, which are Bank of America, Citigroup, JP Morgan Chase, as well as Wells Fargo? And if you really want to drill in to see, so how does Federal Reserve's interest rate cut is affecting the operation of a specific bank, the last part would come in handy, which is going to be, you can directly see the kind of like the word cloud, as well as the summary of how Federal Reserve and the yield curve is discussed within JP Morgan Chase most recent conference call setting. So with that, I'd like to end my talk right here. Again, I'm super thankful that not only I see many people are attending here, I see that many of you are staying until the end. I'm truly appreciative of your time, your attention, and the best gift that we can give each other is our time and our attention. So if you have any questions, I'm going to stay here for a few more minutes until 11:30. That's my local time. Which is Champaign, Illinois. We use Chicago time. So I'm going to stay here for 10 more minutes to answer questions if there are questions. If not, I'm still going to hang around here. If there are other questions you want to talk with me, I will be very happy to answer them. Okay. Last but not least, so I teach in University of Illinois, Geese College of Business. So our university is actually 1 block away from the global headquarters for Wolfram Technology. And that's where I started working with Wolfram Technology. That's where I get to know many of the experts and many of the academic enterprise managers and the practitioner enterprise account managers within Wolfram. So I'm truly impressed with this technology, and it gives me a lot of freedom and creativity in my research and teaching. So for that, I'm also super grateful there as well. Okay, so let me go ahead and end the sharing of my screen.